When the price of something rises, for example, the price of gas or the cost of apartment rentals, the natural inclination is to look for the government to impose a price ceiling to prevent the price from rising to a level that people can't afford. Conversely, if the price of something falls, for example, the price of low-skilled labor, the natural inclination is to have the government impose a price floor to hold this wage rate up so people can earn enough money to live. These two views of price ceilings and price floors miss an important point. Prices aren't levers that can set the value of goods or services. They're metrics that respond to the value of goods and services. For example, suppose your child has a fever. You can take the thermometer and scratch out the numbers and write in lower numbers, and you could point to the thermometer and say, look, we fixed the fever. And clearly this doesn't work. And it doesn't work because the thermometer is not a lever that sets the kid's temperature. It's a metric that responds to the kid's temperature. Prices are very much the same. Altering the wage rate by law or altering the price of gasoline by law doesn't change the value of the labor or the cost of providing the gasoline. All it does is prevent the price from signaling to market participants the reality that's going on. So let's consider the market for milk. The equilibrium price of milk is $4, and there are 200 million gallons of milk bought and sold each week. This is the equilibrium. Suppose farmers successfully lobby the government for a price floor on milk. So now, by law, the price of milk cannot fall below $5. Imposing the price floor does two things. By making the price of milk higher, the quantity of milk that consumers demand will fall from 200 million to 150 million. Second, by forcing the price of milk to be $5 a gallon, milk is now more profitable for dairy farmers to produce. And so they respond by producing more milk. So the quantity supplied of milk rises to 250 gallons per week. We're left with a surplus of 100 million gallons a week. Now, normally a surplus would cause the price to fall. There's a lot of product out there, more than consumers want, so producers compete with each other by offering lower and lower prices. But in the presence of a price floor, by law, you cannot do that. So the price remains at $5 and we get this persistent surplus of milk. Now let's consider whether we're better off or worse off with this price floor. We use consumer and producer surplus to determine whether people are better or worse off. In the free market scenario, the price of milk is $4, there's 200 million gallons of milk bought and sold each week, and the consumer surplus is the area above the price and below demand and out to the quantity sold. This represents the net benefit to consumers in the market for milk. The producer surplus is the area below the price, above the supply, and out to the quantity sold. This represents the net benefit to producers in the market for milk. So these two shaded areas represent the total benefit to society created by this market for milk. Now let's look at the case of the price floor. Imposing the price floor of $5 causes the quantity demanded of milk to be 150 million gallons, the quantity supplied to be 250 million gallons. The quantity actually sold is the lesser of those two numbers, 150 million gallons a week. So in the price floor scenario, the consumer surplus is the area above the price, below demand, and out to the 150 million quantity sold a week. This represents the net benefit to consumers in the market for milk. The producer surplus is the area below the price, above supply, and out to the quantity sold. This represents the net benefit to producers in the market for milk. What's obvious in this case is that the consumers are worse off. The producers possibly are better off, possibly worse off, depending on the shapes of the demand and supply curves. What's clear is that the market as a whole is worse off. We've incurred a deadweight loss. The deadweight loss represents an amount of profit and happiness the market could have generated but failed to due to the price floor. So a price floor makes the benefit generated by the market less than what we had in a free market scenario. Maybe it's the case that a price ceiling actually makes the market better off. So let's consider the market for apartment rentals. In equilibrium, the monthly rental on an apartment is $2,000, and there are 10,000 apartments rented per month. From this, we can see the consumer and producer surpluses and see the total benefit to society from this market for apartment rentals. Now, suppose we determine that $2,000 is too much for many people to pay, and so we lobby the government for a price ceiling on apartments of $1,000 a month. Imposing the price ceiling does two things. First, it makes apartments more affordable for people, so the quantity demanded of apartments rises from $10,000 a month to $12,500 a month. Second, it makes apartments less profitable for landlords, so the quantity supplied of apartments declines from $10,000 a month to $7,500 a month. This results in a shortage of 5,000 apartment units per month. Now, normally, a shortage would cause the price to rise as consumers compete with one another for a limited quantity of product. However, we've now imposed a legal upper limit on the price, so the price cannot rise above $1,000. This means that the shortage becomes permanent. Now remember, the number of apartments rented is the lesser of these two numbers. The quantity supplied is 7,500, the quantity demanded is 12,500. The lesser of those two numbers, 7,500 apartments, is the number that's actually rented. The consumer surplus is the area below the demand curve, above the price, and out to the quantity sold. The producer surplus is the area below the price, above the supply, and out to the quantity sold. And we can see clearly producers are worse off in the presence of the price ceiling. Consumers may or may not be better off depending on the shapes of the demand and supply curves. What's clear is that the market as a whole is worse off. We've suffered again this deadweight loss. In both instances, the price ceiling and the price floor, we encounter a deadweight loss because the government is attempting to force people to do something they would not voluntarily do otherwise. The result is that some people will be better off. The dairy farmer who gets his milk to market first and gets the $5 price, the apartment renter who gets to the market first and gets into an apartment while it's still available, these people clearly are better off. However, there are many other people who are worse off. The farmer who gets to market late and can't sell his milk and would be willing to sell it for $4 but now can't because of the price floor of $5. Or the apartment renter who gets to the market late, can't find an apartment, and would be willing to pay more than $1,000, but can't because of the price ceiling. These people are worse off. What consumer and producer surplus show us is that on the net, there are more people who are worse off than there are who are better off. So as a whole, the market surplus is lower in the presence of a price ceiling and lower in the presence of a price floor than it would be in the free market scenario.